We will discuss today in Section 1, 200 plus billion, precious metals, market wipeout. The trigger, what mainstream media isn't explaining. The pattern, same crash signature, different decade. Your money, why this matters to your portfolio. Hi, welcome to the silent economy. $200 billion. That's how much value vanished from the precious metals market in a matter of days. Gold dropping over $100 per ounce, silver collapsing even harder in percentage terms. Portfolios that people spent years building, gutted in hours. And if you think this was just normal market volatility, just metals doing what metals do, I need you to pay very close attention to what I'm about to reveal. Because while financial media gave you surface-level explanations, told you it was profit-taking, told you it was dollar strength, told you it was technical selling, something much bigger happened beneath the surface. What actually triggered this crash follows a pattern, a specific documented pattern that has preceded every major precious metals collapse in the last 45 years. Same sequence, same mechanics, same players, different decade. This isn't speculation, this is COMEX data, Commitment of Traders reports, bank participation reports, publicly available information from the very exchanges where these markets trade. By the end of this video, you'll understand exactly what triggered this crash, who was selling and why, what happens next based on historical precedent, and most importantly, how to position yourself whether metals recover or continue falling. Because here's what most precious metals investors never learned. These crashes aren't random, they're not unpredictable. They follow a mechanical pattern that's repeated over and over for decades. The only question is whether you'll recognize the pattern or be blindsided by it again. The next 19 minutes will change how you understand precious metals forever. Welcome to the silent economy. Paper versus physical, the 100-1 leverage reality. COMEX, explained, where prices are actually set. The players, commercials versus speculators. The crash formula, 4 stages that repeat every time. Before I show you exactly what happened, you need to understand how precious metals markets actually function. Because if you don't understand the structure, you can't understand why crashes happen when they do. Most people think gold and silver prices are determined by physical supply and demand. Miners produce metal, jewelers and investors buy it. Price reflects that balance. That's not how it works. The price of gold and silver is primarily set on futures exchanges. The COMEX in New York, the London bullion market. These are paper markets where contracts representing metal trade in volumes that dwarf actual physical supply. Here's a number that should give you pause. On a typical trading day, the paper gold market trades the equivalent of 25 to 30 million ounces. Annual global gold mining production is roughly 100 million ounces. The paper market trades a full year's mining supply in less than a week, sometimes in a single day. Silver is even more extreme. Paper trading volumes can represent multiples of annual production in a single session. This isn't illegal. It's how commodity futures markets work. Futures allow producers and consumers to hedge. They provide liquidity. They enable price discovery. But they also create a disconnect between paper price and physical reality. Now here's the framework you need to understand. There are 2 main categories of traders in these markets. Commercials. These are major banks and dealers. They typically take the opposite side of speculative trades. When speculators buy, commercials sell. When speculators sell, commercials buy. Speculators. These include hedge funds, managed money, retail traders. They're making directional bets on price movement. The commodity futures. Trading Commission publishes weekly Commitment of Traders reports showing exactly how these groups are positioned. This data is publicly available. Anyone can access it. And here's where the pattern emerges. Every major precious metals crash in the last 4 decades has followed the same 4-stage sequence. Stage 1, speculative buildup. Prices rise. Headlines turn bullish. Speculators pile into long positions. Commercial short positions expand to match. Open interest grows. Momentum builds. Stage 2, extreme positioning. Speculative long positions reach historical extremes. Commercial short positions hit record levels. The market becomes maximally lopsided. Everyone who wants to buy has already bought. Stage 3, the trigger. Something happens. A news event, a technical level break, a coordinated selling wave. It doesn't matter what specifically. What matters is that selling begins and speculative longs start exiting. Stage 4, the cascade. As prices fall, leveraged speculators face margin calls. They're forced to sell. Their selling pushes prices lower. More margin calls trigger. The crash feeds on itself until speculative positioning has been unwound. This pattern has repeated with remarkable consistency. Let me prove it to you with 4 historical examples. Historical proof, the pattern exposed. 1980, silver crashes from $50 to $10, Hunt Brothers. 2011, silver crashes from $50 to $26 margin Massacre. 2013, gold crashes $200 in 48 hours, paper Avalanche. 2020, gold-silver crash during pandemic, Liquidity. Example 1, the 1980 silver crash, January 1980. Silver hits $49.45 per ounce, an all-time high that would stand for 31 years. Gold peaks above $850. Precious metals mania is everywhere. Stage 1 had been building for years. Inflation was raging. The dollar was weak. The Hunt brothers of Texas were accumulating massive silver positions. Speculators piled in. Everyone believed metals could only go higher. Stage 2 reached its extreme. The Hunt brothers and their associates controlled an estimated 100 million ounces of silver, roughly half of the world's deliverable supply. Speculative positioning was at levels never seen before. Then came Stage 3. The COMEX changed the rules. They raised margin requirements, then raised them again. They limited how many contracts a speculator could hold. They implemented liquidation-only trading for certain participants. The trigger wasn't market forces. It was rule changes designed to force liquidation. Stage 4 was devastating. Silver collapsed from $50 to $10 in 2 months, an 80% crash. Gold fell from $850 to $300 over the following years. The Hunt brothers were effectively bankrupted. An entire generation of precious metals investors was financially destroyed. The pattern was clear. Extreme speculative buildup followed by a trigger event, followed by cascading liquidation. Example 2, the 2011 silver crash. April 2011. Silver hits $49 per ounce, matching the 1980 high for the first time in 31 years. Gold is racing toward $1,900. Precious metals are everywhere in financial media. Silver to 100 predictions are common. Stage 1 had been building since 2008. The financial crisis sparked massive interest in precious metals. Quantitative easing devalued the dollar. Silver had risen from $8 to nearly $50 in 3 years. Speculative long positions reached record levels. Stage 2 reached its extreme in April 2011. Commitment of Traders data showed managed money net long positions at historic highs. Commercial short positions at record levels. The market was maximally stretched. Stage 3 arrived on May 1st, 2011. The CME Group raised margin requirements on silver futures, then raised them again 2 days later, then again, and again. 5 margin hikes in 8 trading days, each hike forcing leveraged traders to either deposit more money or liquidate positions. Stage 4 was brutal. Silver fell from $49 to $33 in a single week. A 33% collapse. It would continue falling to $26 over the following weeks. Billions in speculative value was destroyed. The pattern repeated. Extreme positioning. Margin requirement changes. Cascading liquidation. Example 3, the 2013 gold crash. April 2013. Gold had been consolidating around $1,950 after hitting $1,900 in 2011. The market was complacent. Many believed the bottom was in. Then, on April 12th and 15th, 2013, something unusual happened. In the space of 48 hours, someone sold an enormous amount of paper gold. Estimates range from 400 to 500 tons worth of gold futures, dumped into the market in concentrated bursts, not sold gradually to achieve best execution, sold aggressively in a manner designed to move price. Gold crashed $200 in 2 days, from $550 to below $1,350. Who sold? The CFTC data provides clues, but not complete answers. What's documented is that speculative long positions were flushed out. Hedge funds that had been positioned bullish were liquidated. Commercial short positions were covered at profits. The crash triggered exactly what the pattern predicts. Cascading liquidation as margin calls forced more selling, which pushed prices lower, which triggered more margin calls. By late June, gold hit $180, down over 35% from its 2011 high. The pattern continued. Extreme speculative buildup, concentrated selling trigger, forced liquidation cascade. Example 4. The March 2020 crash. March 2020. COVID-19 triggers global panic. Stock markets crash. You would think this is the perfect environment for safe haven assets. Instead, gold fell from $1,780 to $450 in days. Silver collapsed from $18 to below $12. A 35% crash in silver during a global crisis. What happened? Liquidity crisis. As markets crashed, investors faced margin calls across all asset classes. They sold whatever they could sell to raise cash. Gold and silver, being liquid markets, became sources of emergency funds. Simultaneously, the basis between paper futures and physical metal blew out. Paper prices were crashing, while physical metal became nearly impossible to buy at those prices. Dealers suspended sales. Premiums exploded. The futures market and physical market temporarily disconnected. The Fed's massive liquidity injection eventually stabilized everything. Gold went on to hit new all-time highs above $2,000 by August 2020, but for those who were leveraged long in March, they were wiped out before the recovery. The pattern again. Different trigger, same mechanics, leveraged positions forced to liquidate, prices cascading until the selling exhausted itself. Section 4. What just happened? The current crash. The setup. Record speculative positions. Before crash, the trigger. Multiple factors converging simultaneously. The data, what COT reports reveal about the selling. What's next? Historical precedent for what follows? Let me walk you through exactly what the data shows. In the weeks before this crash, gold had reached all-time highs. Silver had surged significantly. Headlines were euphoric. Gold to $3,500. Predictions were appearing. Mainstream analysts who had ignored metals for years were suddenly bullish. Stage 1 had been building for months. Central bank purchases reached record levels. Geopolitical tensions were elevated. De-dollarization narratives were mainstream. Money flowed into precious metals. The Commitment of Traders data showed Stage 2 reaching its extreme. Managed money net long positions in gold futures had reached levels approaching previous extremes. Speculative positioning in silver was similarly stretched. Commercial short positions expanded to match. The market was primed. Everyone who wanted to buy had largely already bought. The question was, what would trigger the turn? Multiple factors converged to create Stage 3. First, dollar strength. The US dollar index rallied, pressuring dollar-denominated commodities. Second, interest rate expectations shifted. Stronger economic data reduced expectations for near-term rate cuts. Higher real rates are historically negative for non-yielding assets like gold. Third, profit-taking accelerated. After substantial gains, some investors locked in profits. Fourth, technical levels broke. Key support levels that algorithmic traders watch were violated. This triggered systematic selling from trend-following strategies. Fifth, and perhaps most significantly, concentrated selling appeared. COMEX data shows substantial volume spikes during the sharpest price declines, large positions moving through a market already vulnerable to decline. Stage 4 proceeded exactly as the pattern predicts. Leveraged speculators faced margin calls. They were forced to liquidate. Their selling pushed prices lower. More margin calls triggered. The cascade accelerated. This isn't theory. It's visible in the data. Open interest, volume patterns, COT positioning changes, all consistent with the 4-stage pattern that has repeated for 45 years. Now, what happens next? Historical precedent suggests several possibilities. After the 2013 crash, gold consolidated for years before resuming its uptrend. After the 2020 crash, recovery was swift and reached new highs within months. The difference is context. In 2020, massive liquidity injection provided the fuel for recovery. In 2013, continued Fed tightening expectations kept metals suppressed. What's the current context? Central bank purchasing remains strong. Geopolitical uncertainty persists. Government debt levels continue rising. The fundamental reasons people own precious metals haven't changed. But speculative excesses needed to be unwound. That's what this crash accomplished. Whether this becomes a buying opportunity or further downside depends on factors still unfolding. What matters is understanding the mechanics, so you can respond appropriately rather than emotionally. Section 5. Addressing the counterarguments. Gold is supposed to be safe. Why crashes still happen. The market is manipulated. Nuanced reality. Physical is different. Paper versus metal dynamics. Now, I anticipate some objections. Gold and silver are supposed to be safe havens. They shouldn't crash during uncertainty. Here's what that perspective misses. Physical gold held outside the financial system is indeed a store of value. It has no counterparty risk. It can't be printed into oblivion. But the price of gold, as quoted on financial screens, is determined by leveraged paper markets. And leveraged markets crash. All of them. Always have, always will. Owning physical metal for long-term wealth preservation is different from trading leveraged futures contracts. Conflating the two leads to misunderstanding when crashes occur. This time, the fundamentals are too strong. It won't follow the old pattern. Every crash has strong fundamental narratives beforehand. In 1980, inflation was raging. In 2011, money printing was unprecedented. In 2020, pandemic chaos was everywhere. Fundamentals don't prevent technical crashes. They potentially provide the foundation for recovery afterward. But leveraged positions can be liquidated regardless of how compelling the long-term story is. Well, the market is rigged. They manipulate prices to hurt small investors. This is a complex topic. What's documented is that precious metals markets have been subject to misconduct. Major banks have paid substantial fines for spoofing and manipulation in these markets. This is public record. However, painting all price movement as manipulation obscures the legitimate mechanical dynamics that drive crashes. Speculative excess, followed by forced liquidation, isn't manipulation. It's how leveraged markets function. Understanding the legitimate mechanics helps you navigate them. Blaming every loss on manipulation prevents learning. Section 6. Practical steps. What to do now. Understand paper versus physical distinction. Watch the COTI data for positioning extremes. Size positions for volatility. Physical as insurance, paper for trading. Don't buy emotional highs. Have a plan before entering. So what do you actually do with this information? First, distinguish between physical accumulation and paper trading. Physical precious metals held for long-term wealth preservation serve a different purpose than trading futures or mining stocks. Know which you're doing and why. Second, watch the Commitment of Traders data. It's released weekly, free, and publicly available. When speculative long positions reach historical extremes, the setup for a crash is in place. This doesn't tell you exactly when, but it tells you the risk is elevated. Third, size positions appropriately. If you're trading precious metals, understand that 30% to 50% drawdowns happen. Size accordingly. Position sizing that can survive these moves prevents forced liquidation. Fourth, view crashes as information, not just pain. After speculative excesses are cleared, better entry points often emerge. The 2020 crash created a buying opportunity for those who had capital and clarity. Fifth, separate strategy from emotion. Euphoria at highs and panic at lows are the opposite of what works. Having a predetermined plan prevents emotional decision-making when prices move violently. Sixth, physical metal requires patience. If you're accumulating physical gold and silver for long-term reasons, paper price crashes are noise. They may even be opportunities. Your time horizon determines how you should respond. Section 7. Final thoughts and what's next. The pattern. It repeats, because human nature repeats the advantage, seeing what others miss. Next video, central banks and the gold accumulation, you be scribe. Join the silent economy. This is the silent economy. We analyze the patterns underneath the headlines, the mechanics that drive markets, the forces that mainstream coverage often ignores. What you just learned isn't secret. The data is public. The pattern is documented. But most people never look. Now you have an advantage. If this analysis helped you understand something new, subscribe and hit the notification bell. Because next week, we're breaking down why central banks are accumulating gold at the fastest pace in decades, what they know that you should understand, and what it signals about the future of the monetary system. Drop a comment below. Tell me your thoughts on this crash. Were you positioned? How are you responding? I read every comment. Precious metals, markets, will continue to be volatile. They'll crash again in the future, but the pattern will be the same. The mechanics will be the same. And now you know what to look for. Thanks for watching. This is The Silent Economy, and we'll see you in the next one.